The 50% rule says that roughly half of your gross rental income will go to operating expenses, not including your mortgage payment. That is the key part most people miss. Here's the formula. Take your monthly gross rent, cut it in half. That is your estimated operating expenses. Whatever is left after subtracting your mortgage payment from that remaining 50% is your estimated cash flow. Example, a property rents for $1,400 a month. The 50% rule estimates $700 a month in operating expenses. Your mortgage, principal plus interest, is $550 a month. Estimated cash flow, $1,400 minus $700 minus $550 equals $150 a month. Operating expenses include property taxes, insurance, vacancy loss, repairs and maintenance, capital expenditures, roof, HVAC, water heater replacements, property management fees, landscaping, pest control, HOA fees if applicable, and accounting or legal costs. Operating expenses do not include your mortgage principal payment, your mortgage interest payment, or any debt service. The 50% rule is about expenses that exist whether or not you have a loan on the property. Where did this rule come from? It is a long-standing rule of thumb in the apartment and multifamily world. Large property management companies have tracked expense ratios across thousands of units for decades. The averages consistently land between 45% and 55% of gross income for stabilized residential properties. For a single-family rental, the actual number swings more widely. A newer construction home in a low-tax state might run 35 to 40% in expenses. An older home in a high-tax state with full property management could hit 55 to 60%. The 50% number splits the difference. The rule is most useful when you are looking at a new deal and do not have detailed expense data yet. You see a listing, check the rent, apply the 50% estimate, subtract the likely mortgage, and get a ballpark cash flow number in under 30 seconds. If the deal looks promising at 50%, you dig deeper. If it looks terrible at 50%, you skip it and move on. It is a screening tool, not an underwriting tool. The difference matters.